You're listening to AM Now, an Accounting Matters podcast. I'm Adam Olsen.
And I'm Matt Fisser.
We're back after some time off celebrating the 4th of July holidays, and we have several developments to touch on today, so let's get into it. Kicking us off, we have updates from the FASB and tentative decisions they made recently on two of its key projects, software costs and disaggregation of income statement expenses. Starting with internal use software, targeted improvements will be made to ASC 350 with the intent to require an entity to use more judgment to determine when to recognize software costs. To do so, all references to stages will be eliminated from existing guidance, and all software within the scope of ASC 350 will now use the same recognition guidance.
The targeted improvements also streamline the evaluation of significant uncertainties regarding the development activities of the software and unresolved high-risk development issues. The definition of probable will now also be consistent with the definition in the master glossary of the codification. Finally, it clarifies that an entity must perform a unit of account analysis when an asset incorporates both software and tangible components.
In making these changes, ASC 350-50 will be superseded, and website-specific development cost guidance will now be subject to ASC 350-40. Additional clarifications are also included for presentation of cash outflows for software costs. These amendments should be applied prospectively with an option for retrospective application. Up next, the FASB staff will be drafting a final ASU subject to a 90-day comment period.
The FASB also made headway on its project for disaggregation of income statement expenses, also known as DICE. It clarified that disclosure of inventory purchases category should only include amounts recognized in accordance with Topic 330 inventory, and exclude amounts recognized in a business combination, joint venture formation, and initial consolidation of a VIE.
Clarifications were also made for disaggregating other expense captions that contain amounts recognized in accordance with Topic 330, along with using estimates. A practical expedient will also be provided to replace a quantitative disaggregation with a qualitative disclosure. These amendments should also be applied prospectively with an option for retrospective application. And again, next steps here, the FASB staff will begin drafting a final ASU.
Switching things up from the FASB, the AICPA recently issued a sneak peek of its draft of 2 chapters from the upcoming update to their valuation of privately held company equity securities issued as compensation, often referred to as the Cheap Stock Guide. Specifically, these chapters 8 and 9 will provide a framework for valuation considerations of a company's equity securities within secondary market transactions, and provide clarification on how to account for stock compensation when there are secondary market transactions or repos of companies' securities. Feedback is requested over the next 2 months.
In some lighter news, the SEC has announced enhancements to its website. Big news there. The updates to sec.gov include improving the site's compliance with federal statutes and standards, but also include improvements to user experience and site functionality with increased speed and better search engine optimization. There are new quick links features based on the website traffic, and there is a convenient tips and complaints wizard to direct users to the correct forms for contacting the agency.
Staying with the SEC, in a recent attempt to clarify uncertainty surrounding the SEC's recent cybersecurity rules, which require registrants to disclose material cybersecurity incidents within 4 business days, the SEC has issued new interpretive guidance by adding 5 new examples to its Form 8K compliance and disclosure interpretations, known as CNDIs. CNDIs are interpretations reflecting the views of the staff and are therefore intended as general guidance and should not be relied upon as definitive.
Yeah, the new examples illustrate various scenarios of ransomware attacks involving ransomware payments and provide guidance on the determination of materiality and whether disclosure is required. Through these examples, the SEC is making it clear that registrants must go through a thorough and well-documented materiality assessment when confronted with a cybersecurity incident.
Up next, on the international front, the IASB unanimously voted to move forward with finalizing the revision of IFRS Practice Statement 1 Management Commentary. Practice statements are not IFRS standards. Instead, it is up to local lawmakers and regulators to decide whether to require entities within their jurisdiction to comply with practice statements. The board decided to improve the existing practice statement on management commentary in response to investor and creditor demands for better information about factors that could affect a company's ability to create value and generate cash flows.
Yeah, the existing practice statement was issued back in 2010, and the board notes that information needs of stakeholders have since evolved. including the need for sustainability disclosures. A key aim of the project is to support connectivity between a company's management commentary, its financial statements, and its sustainability disclosures, so the IASB will collaborate with the ISSB in its revisions. The board expects to issue the revised practice statement in the first half of 2025. And speaking of the ISSB has announced a 2-year plan aimed at harmonizing and consolidating the global sustainability disclosure landscape in response to market demand. The plan involves collaboration with various organizations like the Transition Plan Task Force, the GHG Protocol, CDP, and GRI to streamline and consolidate sustainability reporting frameworks.
Key initiatives of the plan include harmonizing disclosures about transition plans and measuring greenhouse gas emissions effectively, ensuring alignment with standards like IFRS S1 and IFRS S2, and supporting their implementation over the next 2 years. The collaboration seeks to provide a seamless, global, and comprehensive sustainability reporting system for companies looking to meet the information needs of both investors and a broader range of stakeholders. And closing us out this week, we're circling back to a topic we previously covered regarding the FTC. As a reminder, a few months ago, the FTC published a final rule that effectively banned all non-compete agreements between employers and employees in the U.S. A federal court in Texas has now temporarily blocked the ban in response to a pending lawsuit brought forth by Ryan LLC, a tax services firm in Dallas, who is accusing the FTC of overstepping its statutory authority.
Yeah, this decision postpones the effective date of the ban for the plaintiffs, which includes several other organizations that have joined the lawsuit. The judge overseeing the case expects the plaintiffs to succeed and has stated the FTC lacks substantive rulemaking authority with respect to unfair methods of competition. The court intends to issue a final ruling on or before August 30th. And that rounds us out for this week. For a deeper dive into what's trending in accounting, finance, and sustainability reporting, check out our other podcasts on the Accounting Matters feed on your preferred listening platform. Again, I'm Adam Olsen.
And I'm Matt Fisser.
From your friends at Embark, thanks for listening to AM Now.